Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. In this video, we'll be talking about 5 banking stocks which are looking very attractive after the recent brutal corrections. Now, it's common acceptance in the market that you make the greatest wealth in stocks when there is utmost pessimism all around. That is the same situation for banking stocks in the current market scenario. So, the investment in these stocks, if chosen wisely, could lead to a lot of wealth creation. Now, a disclosure on our part, this is not our own research. This was carried out on a financial website, and we'll be providing a link to the article in the description section. Please watch this video to know more. Now, the first stock on the list is State Bank of India Limited, which is available at Rs 290.90 and the face value for it is 1. The symbol for it is SBIN. Now, State Bank of India provides a range of products and services to personal, commercial enterprises, large corporates, public bodies, and institutional customers. Its geographical segments include domestic operations and foreign operations. Now, due to its large number of branches, no other bank in India can beat SBI's retail reach. It is also one of the banks that can boast of a high CASA ratio of 45%. More importantly, it reported a net profit after 3 quarters during the second quarter of 2018-19, mostly helped by improving asset quality and other one-off events. Due to fall in new slippages, which fell by 24% quarter-on-quarter, its gross NPA came down from 10.6% to 9.8% quarter-on-quarter. Its net NPAs also came down from 5.2% to 4.8% quarter-on-quarter. One-off events that helped SBI to post a profit included the part stake sale in SBI General. While its retail deposits and loan portfolios were doing well, the market punished SBI for the stress emanating from its corporate book. With corporate slippages also coming under control, analysts expect better days ahead for SBI. JM Financial in a report states that they prefer SBI due to the corporate recovery cycle, relatively cheaper valuations, and immensely value accretive subsidiaries. Now, looking at the 1-year chart, you will see that this stock has been a wealth destroyer over the last 1 year, primarily due to the fact that it was making losses. The company is available at a price to book ratio of 1.34, which is not wildly expensive. The dividend yield is also not applicable here, as the company did not pay out any dividends on account of it making losses. Its promoter holding is also a strong number and stands at a figure of 58.51%. The second stock on the list is Bank of Baroda, which is available at Rs 115.20 and the face value for it is 2. The symbol for it is BANK, BARODA. Now, Bank of Baroda is engaged in providing various services such as personal banking, corporate banking, international banking, small and medium enterprise banking, rural banking, NRI banking, and also treasury services. The bank segments include treasury, corporate and wholesale banking, retail banking, and other banking operations. Now, due to sustained improvement in asset quality, Bank of Baroda was able to report good numbers in the second quarter of 2018-19. While its gross NPA fell to 11.8% from 12.5% quarter-on-quarter, its net NPA fell to 4.9% from 5.1%. Recognition of substantial amount of stressed assets will reduce its credit cost in future. Its provision coverage ratio, which is PCR, also improved to 62%, the highest among its peers. Operational improvement was another positive parameter. Its domestic CASA is also well above the 40% mark. Now, balance sheet growth with focus on retail bodes well for risk-adjusted returns and capital consumption. The management's strategic initiatives of growth with quality is working. Bank of Baroda's operational metrics have been steadily improving, and it is on track to deliver return on equity of 10 to 11% by 2019 to 20, says a recent Edelweiss Securities report. Now, looking at the 1-year chart, this stock has again been an underperforming one. The market cap of the company is 30,476.35 crores, which means that the company is a large cap one. The company is not profitable, and hence the price to earnings ratio is not applicable here. It is also due to the same reason that the company did not pay out any dividends. The promoter holding is also a very strong figure at 63.74%. Now, the third stock on the list is the Federal Bank Limited, which is available at Rs 79.90 and the face value for it is 2. The symbol for it is FEDERALBNK. Now, the Federal Bank Limited is a banking company operating through four segments, which are treasury, corporate or wholesale banking, retail banking, and other banking operations. As is evident from the 1-year chart, this company has again underperformed the market and has led to a lot of wealth erosion. Now, among the old private sector banks, Federal Bank stands out because of its strong asset quality. Though there was a small jump in NPA during the second quarter of 2018-19, its gross and net NPA remains at comfortable levels of 3.11% and 1.78% respectively. The flat net profit growth was also because of the increased provisioning. However, with 23% year-on-year loan growth and 22% year-on-year deposit growth, it also did well on the operational front. Though its CASA is not very high at 33%, it has a very strong retail base and the same contributes 95% of its total deposits. Due to increased retail participation, its net interest margin also improved 3 basis points to 3.15% in the second quarter, and this is expected to improve further to 3.2% for the year. A recent Jefferies report says that the company is expected to do well because of the high corporate loan growth, which is 33% compared to overall loan growth of 23%, and gradual improvement in pricing power for its corporate loans, and this should boost profit growth in the coming quarters. Jefferies forecasts 33.2% EPS CAGR between 2017 to 18 and 2020 to 21. Now, just like the other banks, this company has also been a serious underperformer. The company is a mid-cap with a market capitalization of 15,833.51 crores. The EPS of 4.71 translates into a very cheap price to earnings ratio of 16.96, which is much cheaper when compared with the industry PE of 32.26. The price to book ratio of 1.30 is also not wildly expensive. The company has a dividend yield of 1.25%. The fourth stock on the list is Karur Vysya Bank Limited, which is available at Rs 82.45 and the face value for it is 2. The symbol for it is KARURVYSYA. Now, the Karur Vysya Bank Limited is an India-based banking company. The bank is engaged in providing banking and financial services, including commercial banking and treasury operations. The bank's business segments include treasury, corporate and wholesale banking, retail banking, and other banking operations. Now, despite muted second quarter numbers where the loan growth was only 7% year-on-year and flat quarter-on-quarter, analysts are getting bullish on this counter because of the improvement in its fundamentals and reasonable valuations. Karur Vysya is taking several strategic measures like risk-based pricing, improvement in its digital platform, etc. Karur Vysya is also continuing its fat reduction exercises and shut one branch each in Mumbai and Delhi in the last quarter. However, these are long-term measures and won't get reflected in numbers in the near term. The situation is improving slowly and the gross NPA and net NPA is now placed at 7.7% and 4.4% respectively. Since the current growth is muted and expected recovery will take time, investors in this counter should be ready for a long haul. Now, as is evident from the 1-year chart, this company has also followed a similar trajectory and has not created much wealth for its shareholders. The company has a market cap of 6,590.26 crores, which indicates that the company is a mid-cap one. The EPS of 3.15 translates into a price to earnings ratio of 26.17, which is only slightly lesser than the industry PE of 32.26. The price to book ratio of 1.05 is however decent. The dividend yield is 0.73%, whereas the promoter holding is just 2.10%. Now, the final stock on the list is the Jammu and Kashmir Bank Limited, which is available at Rs 39.70 and the face value for it is 1. The symbol for it is JNKBANK. Now, the Jammu and Kashmir Bank Limited is engaged in the banking business. The company offers a range of products and services such as loans, insurance, tax products planning, savings and deposits, cards, mutual funds, and non-resident banking. Now, the 1-year chart shows that this company has been following a similar pattern and not much wealth has been created here in the time when the stock markets were very brutal on the banking sector. Now, this small bank enjoys a dominant position in Jammu and Kashmir with 85% of its deposits and 51% of its loan book coming from J&K. Due to its high CASA ratio of 53%, net interest margin is also at a high 4%. Improvement in business environment and reduction in stressed assets are other points worth mentioning. Net profit for the quarter jumped 31% year-on-year and 78% quarter-on-quarter. Its gross and net NPAs fell to 9% and 3.91% during the second quarter of 2018-19. Analysts believe this trend will continue with pace of stressed asset accretion moderating. Credit cost should moderate further. Credit growth will get a boost from resumption of tourism, tapping of under-penetrated market of credit to apple growers, rise in investment activity, etc. is what an ICICI Direct report has to say. Now the company is a borderline stock between a mid-cap and a small cap, and the market capitalization here is 2210.73 crores. The EPS of 4.44 translates into a very cheap price to earnings ratio of 8.94 when compared with the industry PE of 32.26. The price to book ratio of 0.40 is also dirt cheap. The company has a debt to equity of 0.3489, whereas the return on equity for the stock is 0.0661. The company did not pay out any dividends, and the promoter holding is also a strong factor for this company and stands at a figure of 59.23%. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This is a research which was carried out on a financial website, and we'll be providing a link to the article in the description section. Please go through the article to build more conviction around your investment decision. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.